Welcome to our deep dive into the world of ETFs. Today we are going to compare and contrast SCHG, SPYG, and IWY. Exchange-traded funds, or ETFs as they are commonly known, have become a cornerstone of modern investment portfolios. They offer the flexibility of stocks, coupled with the diversification benefits of mutual funds, all wrapped up in a neat tradable package. Today we're going to focus our attention on three specific ETFs: SCHG, SPYG, and IWY. Each of these funds has its unique characteristics and investment strategies, and understanding these can be crucial when it comes to making informed investment decisions. SCHG, or the Schwab US Large Cap Growth ETF, SPYG, the Spider Portfolio S and P500 Growth ETF, and IWY, the iShares Russell Top 200 Growth ETF, each offer different avenues for growth investment. Join us as we delve deeper into these three investment vehicles. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First, let's explore SCHG, also known as the Schwab US Large Cap Growth ETF. SCHG is a fund that tracks the performance of the Dow Jones US Large Cap Growth Total Stock Market Index. This index comprises the largest US growth companies by market capitalization. By investing in SCHG, you're essentially buying into a slice of these large, growth-oriented American businesses. At its core, SCHG adopts a passive investment strategy. It aims to replicate the performance of its benchmark index rather than try to beat it. This approach has its advantages. For one, it keeps the fund's expenses relatively low, which can be a boon for long-term investors. The fund's expense ratio, a measure of what it costs an investment company to operate a mutual fund, stands at a mere 5 basis points, significantly lower than the average large-cap growth fund. Now, what kind of companies does SCHG invest in? Well, the fund's portfolio is heavily skewed towards the technology sector, which makes up roughly a third of its holdings. It also has notable allocations in the healthcare, consumer discretionary, and communication services sectors. Some of its top holdings include tech behemoths like Apple and Microsoft, along with other industry leaders such as Amazon and Alphabet. The fund's performance history is also noteworthy. Over the past decade, SCHG has consistently outperformed the average large-cap growth fund. It's delivered an annualized return of around 12%, which is rather impressive given its low-cost, passive strategy. But like any investment, SCHG has its drawbacks. Its heavy reliance on the technology sector could be a double-edged sword. While tech stocks have driven much of the fund's past performance, they can also be more volatile and susceptible to market downturns. Also, being a passive fund, SCHG won't adapt its strategy in response to market changes. It will continue to mirror its benchmark index for better or worse. Moreover, SCHG's focus on large-cap growth stocks means it might miss out on opportunities in other areas of the market. Small-cap and value stocks, for instance, could offer attractive returns in certain market conditions, but they're largely absent from SCHG's portfolio. To sum up, SCHG offers a cost-effective way to gain exposure to large, growth-oriented U.S. companies. Its low-cost, strong historical performance and focus on the high-growth tech sector are definite pluses. However, its concentration risk, lack of flexibility, and limited market coverage could be potential downsides. Clearly, SCHG has its unique features that make it a compelling choice for certain investors. Next up is SPYG, or the Spider Portfolio S and P500 Growth ETF. The SPYG is an exchange-traded fund that's been around for a while, and it's designed to provide investors with results that, before expenses, generally correspond to the total return performance of the S&P 500 Growth Index. Now this might sound like a mouthful, but in simpler terms, SPYG is all about investing in large companies from the S&P 500 Index that exhibit strong growth characteristics. So, what does it hold? Well, SPYG primarily holds large cap stocks or shares in large companies. These are companies that have a market capitalization of over $10 billion. And these aren't just any companies. They're some of the biggest and most successful companies in the United States, and indeed the world. You'll find names you recognize like Microsoft, Amazon, and Facebook, among others. Now, on to the performance history. SPYG has had a strong track record. Over the past decade, the fund has consistently outperformed the broader market, delivering impressive returns. But remember, past performance is not indicative of future results. Investing always comes with risks, and it's important to do your own research before making any investment decisions. Let's talk about the pros and cons. One of the biggest advantages of SPYG is its focus on growth. This means it invests in companies that are expected to grow at an above-average rate compared to other companies in the market. This can lead to higher potential returns. Another pro is the fund's diversification. With a broad range of holdings across various sectors, it's not overly reliant on any one industry or company. This can help to spread risk and potentially smooth out returns over time. But what about the cons? Well, one potential downside is that growth stocks can be more volatile than the broader market. This means they can swing up and down in value more dramatically, which can be a bit nerve-wracking if you're not a fan of roller coaster rides. Another potential con is that growth stocks are often more expensive relative to their earnings than other types of stocks. This can make them more susceptible to market downturns. So, who might consider investing in SPYG? Well, it could be a good fit for those who are comfortable with a higher level of risk and are looking for potentially higher returns. It might also be a good fit for those who believe in the power of large, growing companies to drive the economy and deliver solid returns over the long term. SPYG, with its own set of strengths and limitations, offers an interesting option for those looking for large-cap growth exposure. Last but not least, we have IWY, the iShares Russell 1000 Growth ETF. Imagine a fund that gives you broad exposure to large-cap growth stocks in the United States. That's IWY for you. Launched in May 2000, it's part of the iShares suite of ETFs offered by BlackRock, one of the largest investment managers in the world. IWY seeks to track the performance of the Russell 1000 Growth Index, a subset of the Russell 1000 Index, which includes U.S. companies that exhibit potential for high growth. Now let's delve into its investment strategy. IWY uses a passive management approach, aiming to replicate the performance of its benchmark index. This means it holds most, if not all, of the securities in the same proportion as the index. It's a strategy that has proven to be cost-effective over time. So, what's inside IWY? As of the end of January 2025, the fund holds over 800 stocks, making it a highly diversified option for investors. Its top holdings include some of the biggest names in tech, healthcare, and consumer discretionary sectors. Now let's talk about its performance. Since its inception, IWY has consistently provided solid returns, even outperforming the broader market in some years. For example, in 2020, the fund generated a return of over 30%, outpacing the S&P 500. But what about the downsides? Well, like any investment, IWY comes with risks. Its performance is heavily tied to the health of the U.S. economy and the performance of the large-cap growth sector. If these falter, IWY could underperform. Additionally, while its expense ratio is competitive, it's slightly higher than some of its peers. On the flip side, IWY has several advantages. Its broad diversification reduces individual stock risk, and its focus on growth stocks offers potential for higher returns. Plus, its passive management approach keeps costs down. What's more, IWY's liquidity is excellent, meaning you can buy and sell shares with ease. And because it's an ETF, you can trade it just like a stock, offering flexibility that mutual funds don't. In conclusion, IWY offers a compelling option for investors seeking exposure to large-cap growth stocks. It's a well-diversified, cost-effective fund that has consistently delivered strong performance. But as always, it's essential to consider your investment goals, risk tolerance, and time horizon before investing. IWY rounds out our trio, providing yet another perspective on large-cap growth investing. Now that we've examined each ETF individually, let's put them side by side. When it comes to strategy, all three funds, SCHG, SPYG, and IWY, focus on large-cap growth stocks, but they apply different methods to select their holdings. SCHG, or Schwab US Large Cap Growth ETF, follows a market cap-weighted index that screens for factors like strong earnings growth. SPYG, the Spider Portfolio S and P500 Growth ETF, does similarly, but it specifically tracks the growth subset of the S&P 500. Meanwhile, IWY, the iShares Russell Top 200 Growth ETF, focuses on the largest U.S. growth companies. Now let's talk about holdings. SCHG holds a diverse set of around 400 stocks with top positions in tech giants like Apple and Microsoft. SPYG is even more concentrated, with over 50% of its assets in its top 10 holdings, including household names like Amazon and Facebook. IWY, on the other hand, holds just over 100 stocks, with a heavy focus on the technology and consumer discretionary sectors. As for performance, all three ETFs have seen impressive returns over the past decade, thanks to the strong performance of growth stocks. However, their returns have varied. SCHG has outperformed the other two in the long run, with an average annual return of around 10% over the past decade. SPYG's performance has been slightly lower, while IWY has lagged a bit behind both. But remember, past performance is not indicative of future results, and each fund's performance can be affected by a variety of factors, including changes in the market and the economy. The suitability of these ETFs for different types of investors can vary. SCHG, with its broad diversification and solid performance, may be a good fit for those seeking exposure to growth stocks without taking on excessive risk. SPYG, with its focus on the S&P 500's growth companies, could be suitable for investors looking for a more concentrated bet on large-cap growth stocks. IWY, with its narrower focus, might be appropriate for those who are comfortable with a higher level of risk in exchange for the potential of higher returns. So, in a nutshell, while all three ETFs, SCHG, SPYG, and IWY, aim to provide exposure to large-cap growth stocks, they do so in distinct ways. Their strategies, holdings, performance, and suitability for different types of investors vary, offering you a range of options depending on your investment goals and risk tolerance. As you can see, while SCHG, SPYG, and IWY have many similarities, they each offer unique benefits and considerations. We've taken a comprehensive look at SCHG, SPYG, and IWY today. We've delved into the nuances of each of these exchange-traded funds, understanding their composition, performance, and the potential they hold for investors. Let's recap the key points. SCHG, or the Schwab U.S. Large Cap Growth ETF, is a fund that focuses on large-cap growth stocks within the U.S. It's a solid choice for investors looking for a broad exposure to the U.S. equity market. Then we have SPYG, the Spider Portfolio S and P 500 Growth ETF, which also focuses on large-cap growth stocks, mirroring the S&P 500 Growth Index. This ETF offers a narrower focus, aligning with the growth segment of the S&P 500. Lastly, we discussed IWY, the iShares Russell Top 200 Growth ETF. This fund offers exposure to large U.S. businesses that are thought to have above-average growth potential. It's an ETF that strongly considers the Russell Top 200 Growth Index. Each of these funds carries its own unique advantages and considerations. It's essential to remember that the choice between these ETFs isn't about which one is objectively the best. It's about which one aligns best with your individual investment goals, your risk tolerance, and the other assets in your portfolio. Investing is not a one-size-fits-all endeavor. It's a journey that's unique to each of us, based on our financial goals, risk tolerance, and investment horizon. So, when you're choosing between SCHG, SPYG, and IWY, or any other investment options for that matter, make sure you're making a decision that makes the most sense for you and your financial future. Thank you for joining us on this exploration of SCHG, SPYG, and IWY. If you found this video helpful, don't forget to subscribe, like, and share with others who might benefit from this information. Until next time, happy investing!